Welcome to ENT 350 Entrepreneurship Venture Growth Screencast on the balance sheet. A balance sheet. A balance sheet. What is a balance sheet? The accounting balance sheet is one of the major financial statements used by accountants and business owners today. The other major financial statements are the income statement, the statement of cash flow, and the statements of stockholder equity. The balance sheet is referred to as the statement of financial position. A balance sheet represents a company's financial position at the end of a specific date. Some describe the balance sheet as a snapshot of the company's financial position at a point, a moment, or an instant in time. First, we'll start with the categories of the balance sheet. We will begin our explanation of the accounting balance sheet with its major components, elements, or the major categories. There are three different categories. First, assets, liabilities, owner's equity, or stockholder equity. First of all, assets. What are assets? Assets are things that the company owns. They are the resources of the company that have been acquired through transaction and have future economic value that can be measured and expressed in dollars. Assets are also included in costs paid in advance that have not yet expired, such as prepaid advertising, prepaid insurance, prepaid legal fees, and prepaid rent. Examples of asset accounts. Many of you know what petty cash is one example. Temporary investment. Petty cash is a current asset account that represents an amount of cash that's making small disbursements such as postage due, supplies, and etc. And then you got your temporary investments. And then one of the more notable ones are accounts receivable. Account receivable is a current asset resulting from selling goods and services on credit. And you usually get those back in about 30 days. They do what you call a net 30. Inventory is a current asset using ending balance such as report the cost of merchandise products awaiting to be sold. And supplies, of course, your prepaid insurance. Of course, on prepaid insurance, it's a current asset which indicates the cost of the insurance contract premium that have been paid in advance. Of course, you have your cash, your land, and then on land improvement. Land improvements is a long-term asset that indicates the cost of construction improvements, such as you're making driveways, enhancing the land by putting walkways, lighting, and also parking lots. Then you have your buildings and your bond issue costs. And on buildings are a non-current or a long-term asset account that shows the cost of a building, excluding the cost of the land. Now you have your classifications of assets on a balance sheet. Now we talked about assets, your current assets, and long-term asset, and now you're talking about investments. Investments are long-term assets. Long-term assets category of a classified balance sheet, which appears immediately after your current asset. The list in this category would be bonds, funds held by construction, and cash surrendered for a life insurance policy. One of the major classification of assets would be your property, plant, and equipment. Now, these include things such as land, building, leasehold improvements, equipment, fixtures, delivery truck, automobiles that are owned by the company. Then you have your intangibles, your intangible asset. These assets are things such as copyrights, patents, goodwill, trademarks, and mailing lists. These assets will be reported at cost on the balance sheet after property and plant and equipment. And you have your other assets. Other assets are usually long-term assets that are not classified as investments or property, plant, equipment, or intangible asset. One example would be a bond issue cost. The next on hand will be our liabilities. Liabilities. What are liabilities? Liabilities are obligations of a company. They are amounts owed to creditors for a past transaction. They usually have the word payable in their account title. Now, most of the liability accounts will have payables. Examples: note payables, account payables. Along with the owner's equity, liability can be thought of as source of the company asset. They can also be thought as the claims against the company assets. Examples of liability accounts. As I said before, you have the note payables. One of the more common payables would be account payable, salary payables, wage payable, interest payables, income tax payables, and some of the ones you probably have not noticed is such as customer deposits, warranty liabilities, lawsuit payable, and earned revenues and bonds payable. Of course, note payable. Note payable is an amount of a principal due for a written promise to pay. Usually you have loans and banks that have notes because they have promissory notes. An account payable is it's the same, but it's the opposite a little bit. This current liability account shows the amount a company owes for its item or service purchased on credit for which there isn't a promissory note. And if you look at salaries, I'll just touch bases on salaries and wages. Salaries and wages are sort of similar, but a little different also. A salary is a current liability account which reports the amount of salaries earned by a company's employees, which have not yet been paid by the company. Wage payable is a current liability account that reports the amount owed to employees for hours worked but not yet paid as of date of the balance sheet. There's a little difference there, but similar. And of course, we know what income tax payables are. They are current liability because it reflects the amount of income tax currently due from the state and federal and local governments. And if you didn't know what customer deposit was, now we're looking at classifications of liabilities, current and long term. The only difference is current liabilities due within 1 year of the balance sheet date. Obligations for the long term of the enterprise is not payable within that 1 year of the balance sheet date. Some examples are bonds, and then you're talking about long-term notes. Now, if a company has a loan payable that requires you to make monthly payments for several years or more, the principal that's due within the next 12 months is the only thing that you will record as a current liability. The remaining principal, that amount, will be reported as a long-term liability. This is a quick snapshot of what a balance sheet is, just for the assets and the liabilities. Has a little bit on the owner's equity, but we want to focus in on the current assets. You will list your current assets, your investments, your property, plant, equipment, intangible assets, and then you'll come up with your total assets, and vice versa with the liabilities. Now, owners' equities and stockholders' equity. Owner's equity is basically it's a word used on the balance sheet for when you have a sole proprietorship. You use stockholder equity. That word would be used when you have a corporation. Now, owner equity along with the liability can be thought of as a source of a company assets. Owner's equity is sometimes referred to as the book value of a company, because the owner equity is equal to the reported assets amount minus the reported liabilities amount. Now, if you look down at the bottom of the page, you'll see basically owner equity equals assets minus liability. It's a simple equation where you can kind of understand how do you come up with the owner's equity. Classifications of an owner equity and of the balance sheets. You have three of them. You have paid in capital, retained earnings, and the treasury stock. Now, paid in capital, also referred to as the contributed capital is the amount of the corporation received from stockholder when the corporation issues stock. So when they issue the stock, basically, is what the capital they bought the stock for. So paid-in capital is also referred to as the permanent capital. It's the amount paid or contributed by stockholders in exchange for shares of the corporation stock. Retained earning is the cumulative amount after tax net income earned by the corporation since its inception, minus dividends that have been distributed to the stockholders since the corporation began. Treasury stock. Treasury stock is corporation-owned stock that has been repurchased from the stockholders. So basically, when they repurchase their stock, you have the treasury stock. And in conclusion, just wanted to show where on the balance sheets you have your current assets. Then now the first step, you would list your current assets and their amounts. Your investments, if there is any investment, your property, plant, equipment, your land improvement, building equipment, and your depreciation, of course. And tangible assets, we talked about the goodwill, and then you will come up with your total assets. On the liability side and vice versa, you'll list your current liabilities, which would be your payables, and your long-term liabilities would be your payables and your bond payables, and you will come up with your total liabilities, your total long-term liabilities. Stockholder equity, of course, your retained earnings and your treasury stock if you have any, and you would add those together and you will come up with your total liabilities and stock equity, and it should balance out that way. So if you see here, your total liabilities and stock equity balance.